Hello, everyone, and thank you for tuning into this update. I'm Joshua Dobi. Appreciate so much you taking a little bit of time with me here as we have now crossed over, I know, ready or not, the halfway mark in the calendar year. We're now into the third calendar quarter of the year. Second quarter is now behind us. And we're looking at now not only where we've been a little bit, but also certainly where we think we might be going here over the next weeks and months. So I want to take just a few minutes, talk a little bit about where we've been, and then probably most importantly, a little bit about where we think things might be heading. So I want to be respectful of your time. I'm going to go ahead and dive right into it. Let's do a quick recap on the first half of this year as measured by our most popular stock indices here in the U.S. The markets were generally positive. Now, if you're a small cap investor, and even if you were in some technology companies, not just the small ones, but even some of the largest ones, not only were you not modestly positive, but you were notably negative in the first half of this year, even in the double digits. And I'm looking at companies like Apple, like Amazon, that were in that kind of camp. But if you look at our most popular stock indices, Dow Jones Industrial Average, S&P 500 Index, the NASDAQ Composite, those are the three which are most often used here in the U.S. Generally speaking, positive in the 4 to 5% range, overall positive return in the first half of this year. Now, you may be hearing that and say, boy, I really didn't expect that would be the case. And actually, if you would have looked at the first quarter of this year, I can understand why that might be your sentiment. First quarter of this year, towards the end of March, into the beginning and mid part of April, was pretty rough insofar as the markets were concerned. The word tariff became a very ubiquitous word in a very short amount of time and was really percolating through our airwaves, still is, but certainly was very rampantly percolating through our airwaves at that time. The markets didn't know how to quantify that, took a sharp dive for a couple of weeks. However, what happened after that time, about 2.5 weeks, the markets notably rebounded in a positive direction, which has now resulted, at least as measured by our market indices, in a modestly positive return here at the halfway point of the year. Now, as we're looking at that, you may say, well, looking at it, 5% or so, 4% or so for a half of year is a very good return. I'd agree with you, at least insofar as we expect markets to perform over time. That would be a very positive year. It's always interesting how we got here in terms of market performance, especially when we take into account geopolitical events, most specifically, and it seems like a long time ago already because of how our news cycles run, but insofar as our involvement in bombing of nuclear production sites in Iran, that has now moved beyond the markets very, very quickly, meaning that the markets have put that notably behind it in a very short amount of time. There appears to be some level of discussion between Iran and Israel and the U.S. about some kind of resolution. Nothing at this point as of the time of this recording. We also have all of the issues that are still going on with tariffs, which actually in a couple of days, July 9th is actually the next, let's call it, date marker that's out there in terms of some of the delays that have been put in place. Is that delay going to hold? Is it going to be extended? Is there going to be some kind of resolution as a result of negotiation? In the meantime, I don't know is the best answer I can give you. Those kinds of things change not only on a daily basis, but sometimes hour by hour. And so those things are still very much in flux. We don't know at this point how those things are going to resolve, whether it's with China or whether it's with any of Canada and any of our other trading partners. It's really hard to determine at this point. But the markets, by and large, not only by their performance through the first half of this year, but even insofar as the futures markets are concerned, which tend to give a little bit of an indication about how the markets are expecting things to go going forward, they don't seem to be too incredibly concerned about it. Now, that can change on a dime, literally. So if we get some unexpected news that reverberates through the system, I would expect that the markets would probably respond relatively negatively, at least in the short run, if that would happen. But with regards to geopolitical events, with regards to tariffs now, and also with regards, third one I'm putting in the mix here, because no good presentation has more or less than 3 points, is with regards to the Federal Reserve. The Federal Reserve has been very much on display this past week, most especially with the testimony given from Fed Chair Jerome Powell, not only before the House Banking Committee, but also before the Senate Finance Committee as well, giving his semi-annual testimony up on Capitol Hill, and didn't seem to rattle the markets all that much. As a matter of fact, sometimes I feel like the markets move almost based upon the number of syllables that the Fed chair utters. Didn't seem to be the case this time around. So the market seems to be relatively settled insofar as immediate volatility is concerned. So that's a little bit about where we've been. And now the multi-trillion-dollar question, where are we going? Well, you know me well enough by this point to know that I don't have any more idea than anybody else. But what we try to do is to take a look at the data points that we have in front of us, put it over the metric of history, and try to get some understanding about where we believe the markets, generally speaking, tend to go in environments like this one. So as we're looking forward for the balance of the year, I would expect that we're going to have some increased levels of volatility. I don't know the reasons at this point. Frankly, I'm looking at that more on a technical basis. Because we had such a sharp downturn towards the end of the first quarter, but such a sharp return, not only back to where we were, but even beyond, bumping against some record numbers as far as the indices are concerned, and certainly some of our high-flying stocks are concerned. Also, a whole collection of companies that have yet to show a profit, which have also rebounded pretty dramatically. That's a little bit, again, of a technical indicator that we may be a little bit overbought, which means a little bit overextended in our exuberance at this point. So I would expect that we're going to have some measure of negative volatility here ahead of us. Certainly in the second half of this year, perhaps even in the third quarter as we get to the later parts of the summer and into the Labor Day season. Is what we're expecting at this point. It's not to say that we expect to crash out or there are any flashing red lights that would indicate some kind of collapse of any kind. We certainly don't see those kinds of things, but we definitely see some cooling off that is out there because we've just bounced back too much too fast, in our opinion, from where we were there at the end of the first quarter and beginning of the second quarter there in mid-April. So that's what we're watching there on a volatility standpoint. Insofar as commodities are concerned, a lot of attention was given to the Strait of Hormuz, especially as the U.S. made the bombing runs against the nuclear production facilities in Iran. There has been a lot of attention given as to whether the Strait of Hormuz may get shut down or there might be a restriction in traffic, which would spike most notably crude oil prices if that would be the case. Frankly, the crude oil market has not been very volatile at all, with any concern about that happening in the relative near term. There was about a 6, 8, maybe even 10% fluctuation in a very tight window. That has largely gone away. So we don't see that the oil and commodities markets are necessarily concerned about that at this point. That's always a factor that's out there in the mix, but we don't see that in terms of commodity and specifically oil prices at this time. Another big factor in that mix, a little bit of a sidebar here, very, very different from even 15 years ago, let alone 50 years ago. The United States is now a net exporter of oil, as opposed to when we were very much a heavy importer of oil, certainly 50 years ago, and even as little as 15 years ago. That reduces the amount of price shock that we see whenever things are happening like what are happening in the Middle East, and specifically with the Strait of Hormuz. Put another way, we have enough supply here to absorb some tightening as far as supply and production is concerned on a worldwide basis because of how much we're producing here in the U.S. and U.S. territories. That's a huge, huge factor. Just want to toss that out there to you as well. Not saying that we're absolved from price shocks, certainly not the case, but it is a very, very different environment now than it was even a decade or a decade and a half ago, relative to supply and relative to from where that supply is coming. So again, looking at commodity prices going forward, don't see anything outside of a geopolitical shock, and that is always a risk that's sitting out there. With regards to some things that we feel are overextended in the market right now, especially in the more aggressive end of the markets, we're concerned about that. I mean, there are some things that are positive 60, 80, 100% or more just since January 1st. Some of those companies they're not even producing a profit yet. That tends to be a sign that we're a little bit overheated in parts of the market. We're watching that very closely. Then coming back to the Federal Reserve, a lot of speculation. And even the Fed board chair, I would say, showed his hand a little bit in saying that some rate cut possibilities are on the table before the end of this year. My personal opinion relative to what we see in the macroeconomic data is that there really isn't anything that would support that with any substantive nature at this point. It's not that I wouldn't like for rates to come back. It certainly is very good for the equity markets and in a number of other instances insofar as lending and borrowing is concerned. But it doesn't appear to me or to us here at North Main Financial that there are enough macro factors to warrant a rate cut at this point. Unemployment, one of the huge factors that the Federal Reserve watches very, very closely, is at very nearly an all-time low. When we're looking at inflation, very much under control, especially when compared to where we were here just a couple of years ago. Now, that's not to say that there aren't parts of the economy that are much more elevated in terms of inflationary pressures, but I'm thinking about things like the grocery store, no doubt about that, that we're seeing some high inflationary pressures there across almost all areas. But when we're looking at the economy overall, we're not seeing those kinds of things because those kinds of pressures are offset, for example, by an oil price, which is definitely lower than was expected to be at this time in our economic cycle. So when we're putting all of those factors together at this point, we personally here don't see that the Federal Reserve should be cutting rates. It's possible, though, that before the end of the year, for any number of reasons, that we may get one or two. That's certainly what the futures markets are indicating at this point. But again, from a macro data standpoint, we're not seeing that is a very high possibility. But certainly we'll keep you up to date on that. So when we put all of that together relative to what we expect, let's say, the equity and the bond markets to do between here and the year end, at this point, we're very, very reserved in what we expect. Frankly, I don't expect that the equity markets are going to push much higher than where we are right now. And if we would end the year pretty much where we are right now as far as the overall indices are concerned, I would consider that to be a pretty successful year, especially against the backdrop of 2023 and 2024, which were superlative years from an index performance standpoint. Having a more modest year would actually be appropriate for the market to do and certainly would be healthy for it to be in that kind of space. Same thing with the bond markets. If we don't get much movement in interest rates, the bond markets overall, as measured by our most popular bond indices here in the U.S., positive about 3% year to date. I don't expect a whole lot of movement there either. That also would apply to looking at CD rates and high yield money market rates, which are right now in the 3.5% to 4.5% range, roughly on an annualized basis. At this point, I don't see a whole lot of reason that they're going to fluctuate either in a positive or a negative direction with any significance. All of that can change in a moment, but at this point, we don't see that happening. So we don't want to be too negative in how we're looking at the balance of the year, but we also want to be realistic in terms of our expectations. And at this point, again, frankly, to repeat it one more time, if we would end the year pretty much where we are right now, both in the equity and the bond markets, we would consider it to be a pretty successful year. Well, folks, again, in being very respectful of your time, I want to bring our time together here to a close. You know, at any time, if you would like to reach out to us to discuss your particular portfolio, if you'd like to take a look at what is happening as far as the markets are concerned with your particular holdings, what are the things that you're seeing? I just had a conversation about the price of gold being at an all-time high, price of silver being very strong as well. What kind of trend is that going to continue? Always, always, always very happy to have those kinds of conversations with you. Feel free to reach out to us at any time. Certainly also, if you are one of my Buccos fans here for the baseball season, it's been another tough season. We're getting into the dog days of summer, and it already feels like that it would be better if the season would end mercifully sooner rather than later. But that doesn't mean that we don't enjoy it, and hope springs eternal when you're a true fan. But we're getting ready for training camp for football teams starting up here. Before you know it, we're going to be kicking off the football season. Labor Day weekend is going to be here in another breath or two. it just runs by so fast. So I hope you're taking time to enjoy your summer season. And certainly if you're one who has kids or grandkids that are out of school and enjoying the summer seasons, I hope you're able to do that with them as well. Well, friends, again, thank you so much for your time. Always feel free to reach out to us if we can be a help in any way. And until that next time, I'll look forward to talking with you soon.